This is an exercise number 4 for Chapter 8, and it says, valuation of accounts receivable. A company that extends credit to its customers assumes some risk that one or more customers may not pay the amount that they owe. Amounts that are never collected are an expense to the company. There are two methods to record bad debt expense: the direct write-off method and the allowance method. The blank follows GAAP, that's the allowance method, follows generally accepted accounting principles, because it consistently adheres to the matching principle, where we are matching our sales with the bad debt allowance or bad debt expense. The company must also follow the conservatism principle and report receivables at the amount it expects to collect. In other words, the net realizable value or amount. What happens to the difference between the actual amount due and the amount the company expects to collect? The difference, which is an estimate, is stored in a contra account called the allowance for doubtful accounts. The balance in the account is deducted from the balance of the accounts receivable account to determine the net realizable value of accounts receivable. The use of the allowance account prevents assets from being overstated on the balance sheet. So we're going to have the allowance, which is the contra account, and brings it down. Now there's also an income statement approach. Under the allowance method, there are two approaches to calculate the amount of the adjusting entry at the end of the period: an income statement approach and a balance sheet approach. Under the income statement approach, the percentage of net credit sales expected to be uncollectible is estimated at the end of the period based on the company's expected experience in prior years. The formula is net credit sales times a percentage expected to default or be uncollectible. That equals our estimated bad debt. The income statement approach focuses on calculating the bad debt expense, and the balance sheet approach focuses on the ending balance of the allowance of doubtful accounts. The accountant for Flowers R Us gathers the following data before making adjusting entries. Accounts receivable balance $32,500. Allowance for doubtful account balance is $150. Net credit sales $750,000. You collect data for the prior years and find that the uncollectible accounts receivable average is 1.5% of the net credit sales for each year. Estimate the amount of the bad debt expense for the current year. Well, I'll take the $750,000. I'm going to multiply that by 1.5% or 0.015, and that equals 11,000. So I'll take the sales here, that's 750,000 times 0.015, or sorry, 1.5%, and that equals 11,250. Next, complete the information for the adjusting entry. Bad debt expense, 11,250, and credit the allowance for doubtful accounts, 11,250. So we're just going to be entering that percentage, or that amount based on a percentage, to the account. That's going to be our journal entry. What is the net realizable value of accounts receivable for the adjusting entry? Well, before, it's going to be 32,500 minus 150, so 32,150 minus 150 equals 32,000. So I'd put 32,000. That's before my adjustment. Now after the adjustment, I'm going to take that 32,000 and I'm going to subtract $11,250. So Oh, right. Okay, so 32,500 minus 150 is 32,350. Okay? Now I'm subtracting another 11,250 from that. So I would have 21,100, it looks like.